Thank you all very much for coming. My name is Mark Elliott. I'm the head of international residential at Savills here in Hong Kong. We thought it was pretty timely to give a UK market update and just a general update on what's going on in the global economy, but also more directly in the UK and in London. So we work very closely with London Square and with Aldam and have done for many years. I've been in Hong Kong for the last 18 years or so I've seen many ups and downs. But what we wanted to provide you with today was an outlook of what Savills see is going to happen over the next few years, both in the UK, but more specifically in London as well. We know that some of you obviously have investments in the UK. Some of you are considering it for friends, for family, for educational purposes, or for needs-based, but also from an investment perspective as well. So hopefully the next 20 slides or so can give you a bit of an idea of what's going on and what we predict is going to happen in the coming few years. So budget was not as bad as feared. Buyers and sellers are re-engaging in the market. We're seeing a lot more people coming back to the market post-budget than we did pre-budget. That's obviously pretty logical. The same thing has happened in Hong Kong. It was very, very busy before there was an increase in stamp duty for our Hong Kong local resi team. And then there was a slight drop off after that. So obviously, you know, depending on what happens with these budgets from the government depends on the result and therefore how many inquiries come to follow. But the UK fundamentals remain strong. First and foremost, education. You know, whilst we see a lot of things on Twitter and on social media about, you know, safety, in reality, compared to many other European and Western cities, especially in the US, the UK and London is still very safe. It's a safe haven in terms of tax jurisdiction and rule of law. That hasn't changed. Currency and business. So, you know, I don't want to get into the geopolitical story and what's going on in the Middle East, what's going on with America. But I think common sense is prevailing with a lot of people, and people are starting to realize that parts of Europe, especially London and the UK, whether it's Oxford or Cambridge or the South Coast, are a much better and safer option for their money. And that's not to say that you can't make money in the Middle East and you can't make money in America. You can. But if you're talking about safe havens and investments, we understand why our clients are gravitating more towards the UK and London. The Renters' Right Act gives certainty to landlords and tenants, and it's something that isn't going to change. So whilst there are parts of it that are a bit onerous and not ideal, it also does give clarity, and it works in both the landlord's favour and in the tenant's favour. So this is interesting. The GCC, which is essentially the United Arab Emirates, purchased London property in the last 12 months ahead of New York, Paris and other global cities. I think there's a reason for that as well, that a global safe haven and a historically sustainable market where both rental return and capital appreciation has slowly been going up on a 10-year basis. Of course, there has been peaks and troughs throughout that time with Brexit and with the tax implications that we've seen in the UK over the last 5-7 years. It's been quite a rough ride. You know, for some people like myself who own property in central London, you know, prices have gone down. You know, so it's not all sunshine and rainbows, but the reality is that the smart money or the big money is really focused on London and the UK specifically at the moment. So delivery of new homes is at a record low, and that means that there's really limited choices. So when things do come up in specific locations that are historically desirable or where people want to live or educate their family or themselves, then you must strike at those opportunities because they are so few and far between. The reason for that is the planning constraints and the green belt and all of the different laws and regulations that we have in the UK that make it very difficult to just build like we can do in Hong Kong or even China. So it's a very different market. The London FTSE 100 has outperformed all US major industries last year, and that is even, including the Mag 7 with Nvidia and Tesla and all of those companies in the NASDAQ. The FTSE 100 outperformed. London's ranked first for the 13th year running in the Global Power City Index. So I would recommend you have a look at this because I also have Twitter. I also have Instagram. I see everything that everybody else sees, but I also go back to London, which is where my family is from. 2 or 3 times a year, and I don't see it with my own eyes, nor does the Global Power City Index, which for the 13th year in a row has ranked London number 1. Strong capital inflows, as I talked about, Middle Eastern family offices from 25 million investment in 2014 to 245 million in 2024 to 2025, not 2014. A huge increase. There is a reason for that, right? Family offices are pretty astute, savvy investors, so it's quite a good proposition to follow, right? If the investment, I can send this to all of you, so you can take pictures all you want, but we can also send it to you. London is safer for serious crimes than New York, Paris, and Berlin. Again, it's really important that we point this out because we don't want to, gloss over the fact that people are concerned, especially, in this part of the world with Hong Kong and Singapore being so incredibly safe. Of course, London has more crime and is slightly more dangerous than where we are today. But when you compare it on a global scale and the size and the scale, London actually is not a dangerous place to be. JP Morgan announced a new 280,000 square metre tower in Canary Wharf, which is, a real distant story from what we were hearing in COVID times and just after COVID times, where everybody is going to be on Zoom calls and all of the big corporations such as Savills or London Square or wherever you guys work are closing down and everyone's going to be working from home. This is not true. And nowhere is that more apparent than London, with the City of London, and I'll show you on some slides in the future, and the expansion of some of the offices in the City of London, but also the influx of new corporations that are going to be calling London or the UK their home. These are just some of the recent headlines. So Microsoft have extended and are looking for a second office along the Elizabeth line. They already have a huge centre outside of London, close to Reading, but they're looking for new spaces on the HQ line with Savills and our commercial team. Visa relocates its European headquarters to Canary Wharf. Again, Visa is a pretty strong, powerful, cash-rich company. They could go anywhere in the world. They could go to Ireland and get tax breaks, but they don't. They go to London. And the reason that they go to London is because that's where the talent wants to be. Nobody wants to live, well, that's not true. People do want to live in Ireland, but more people want to live in London. So the reason for things like this, are not just tax moves. It's to attract talent and retain talent. Again, you can read these yourself, JP Morgan, Amazon. These are the biggest companies in the world. These are the future, whether it be, AI or banking or SaaS. If the talent wants to be there, these companies will retain them and they will open offices there. And I think that's a huge vote of confidence. That was one of the most important slides. Equally, I know this slide is a bit because a lot of the venture capital is California, is San Francisco, is Palo Alto, this part of the world. But when you look at it on this scale, the UK has a huge VC and tech hub when you compare it to the rest of Europe. So again, everybody is not leaving. The non-dom law did not mean there was a mass exodus and everyone working there left because they don't want to pay tax. That couldn't be further from the truth, and the facts clearly demonstrate that. £4.2 billion just last year of venture capital. Again, education, as I said, I've been here for nearly 18 years now, and I would say that 50% of the people that I've sold to and that own properties in London are doing so because they were either educated in London or they want to educate their children in London. That's not going to change. Cambridge isn't going to go. Oxford isn't going to go. LSE, Imperial, King's College, they're not going anywhere. In fact, they're expanding. They're opening up what you wouldn't call them offices, schools elsewhere in the world. But fundamentally, they're not, when you open up a Harrow School in Hong Kong, it's not Harrow School, it's a business that pays for the license of Harrow School. Harrow School is in Harrow. King's College is in central London. Imperial College is in central London. You get the gist. I don't need to go on about it. But again, the facts speak for themselves. The amount of people in China, in Singapore, in Korea, in Japan, in Hong Kong, in Africa and India that want to educate their children far surpasses anywhere else in the world. And I don't think that's ever going to change. Needless to say, I wasn't educated in any of those places, but I wish I was. Top global cities for tech, foreign direct investment projects. Not so great. Really good. Again, it's just another touch point and fact to show that what we see on Twitter and what we see on our short feeds for clickbait isn't really what's actually going on, but it does sell papers. So the facts are the facts. The world's most internationally collected airport, 84 million, I think it is. Yeah, 84 million passengers travel through London Heathrow. Whether there's going to be a new runway or not, just decide the point. Whether these airports are, certainly these, are well run is up for debate. But the reality is that more passengers travel through London Heathrow than any other airport in the world. And I think, again, that is a huge plus for the city and for the income and the GDP of that city. We touched on it earlier. I'll touch on it again. The world's 10 most powerful cities. You may be surprised to see London at the top, but it's been at the top for the last 13 years. Shanghai is climbing quite rapidly. I'm not sure whether Dubai will be on there again next year, but I'm pretty sure London will be at the top again. So supply and demand dynamics, which as we know in the real estate industry is really what drives everything, right? If you have loads of supply and no demand, guess what happens to prices? And the opposite happens when you have loads of demand and no supply. The UK government is not as efficient as the Hong Kong government. And I say that without any exaggeration at all. We all know if we own property in the UK, or if we've been to the UK, or if we've queued up for a driving license in the UK, it can be a pretty tedious task when compared with Hong Kong. But the same applies with real estate. Right? They can't build and redevelop Kai Tak. It would take England 5 centuries to do what Hong Kong has done in Kai Tak in 5 years. Right? It doesn't happen. But yet there is far more international demand to be in London than there is to be in Hong Kong. That is a fact, right? There is a lot of Chinese that want to be in Hong Kong for a plethora of different reasons. But that's really it. And then you've got the odd Guilo that comes here to work. But really, when we're talking about an influx of demand, somewhere like London and New York, has genuine global demand, whether it's for education or it's for work or it's for pleasure and tourism. London is always going to be at the top of that. So if you can't build enough homes, either the rental market is going to go through the roof, or in time, capital gains are going to go through the roof, right? You have to build enough supply to feed the demand. So whilst this is a fairly sort of pie in the sky target of where we need to be, the answer is somewhere here, right? Nobody knows exactly how many houses you need to build to feed the demand, but this is what we have been building. And this is for the last 26 years. We have been so far below where we need to be in terms of supply and demand. And whilst this isn't an aggressive sales pitch, if you have to buy today is the bottom of the London market, that's not what I'm saying. That's not what we're saying at Savills. What we're trying to do is give people timely advice, which is what we've been doing for the last 20 years, as to where to start looking for future capital growth, where there might be investment opportunities over the next few years. And we think that London, and especially some cities around London, mostly in the south and southwest of the UK, are going to do very, very well over the next 5 to 10 years. And the reason is mainly for what I've just touched on when it comes to education and the influx of talent, but also because there's no supply. When I met some of the people in this room 10, 12 years ago, it was a very different story when it came to supply. Every weekend there would be a new exhibition, a new project coming to town in Singapore, and they would roadshow to Tokyo and Hong Kong, and they'd sell all of these flats. Everything was great. But there was a lot of supply. Right? This is not happening anymore because of inflation, because of Brexit, because of the cost to build, but mostly because it's very, very bureaucratic and it's very hard to get planning permission. So it's very hard to build en masse. To do huge redevelopments like Saisha or Kai Tak or Elements, it's just impossible. So to feed that demand is always going to be below where it needs to be. So again, this just touches on that. And I will share this with all of you after so you can see all of this information, because I know I talk very quickly. But this is a great slide. Okay, so this is the blue or black or whatever you want to call it, is the need, the demand for housing. This is what we need to do. The red is the new homes being built. And the blue is the new homes within planning permission. So we're pretty much screwed everywhere when it comes to supply, but we're really screwed when it comes to London, and especially central London, because again, mainly education reasons and the influx of talent to these banks, to Microsoft, to Amazon, to all the companies that we talked about that are moving there. This is what we need, this is what we have, and this is what we're building. It's a big problem. You can get the same graphs on a Hong Kong government website. It doesn't look like this. Okay, and this is really what people want to see, me too, me included. These are the house price forecasts. So whilst in Hong Kong, we are an international residential sales team. So of course, we want number go up. In the UK, we advise the UK government. Lucian Cook, who is a MBA, a doctor in research and consultancy and valuation, he is not a salesman. His job is to advise the UK government, to advise developers, to advise on land acquisitions and sales, right? These are figures and predictions that are usually correct. If you ask me, it's going to go up 500% in the next 5 years. But I'm the sales guy, right? The truth is, or where we see more accurate is, for example, 2026 up 3%, and over 5 years up 27.6% in the north and Scotland. mainly driven by Edinburgh, St Andrews and places like that draw international demand. So whilst London on a 5-year basis doesn't look particularly attractive, the slides that I showed previously on housing demand and housing supply means that certain pockets and areas in London will far outperform the national average. And what I mean by the national average or the national commentary is 13%. So, London is a series of different villages built up in one big city. For example, Canary Wharf may do okay and may, exceed 13% over the next 5 years. Wimbledon certainly will, because there's nothing built in Wimbledon, and you've got Wimbledon Common, and you've got the tennis, and you've got, the education that surrounds the Common. So for me, when you look at London, it's very difficult to just say, okay, all of London is going to go up this amount. Somewhere in Holland Park and Notting Hill will probably do better than somewhere in Canary Wharf and Bermondsey for the time being. And again, it's really down to supply and demand. So again, I can share this with all of you. It's quite interesting, and it breaks the UK up into regions to give you the growth. Rental is doing incredibly well at the moment. So whilst we have a lot of people in the UK talk to us about issues that they have with service charges or issues that they have with rent pricing or reselling, sure, everybody in the world is going through that at the moment, whether they're in America or whether they're in Hong Kong. Real estate is not as liquid as buying an ETF, right? And the introduction of ETFs means people are very eager or fixated on liquidity. But buying real estate, is about preserving capital and making slow, sustainable growth over time. It's not about making 10% and then trading it. It has been, and it will be again through markets, because, when markets get hot, you can buy and sell and you can trade off plan properties, just like you could in Hong Kong before legislation changed. You still can in London, but it's not the right time, right? What we're talking about now is capital preservation in a time of inflation. Right? The US has $40 trillion worth of national debt. They don't make $40 trillion a year. So that debt's going to continue to go up. Hong Kong has an awful lot of debt. China has an awful lot of, everywhere has a lot of debt. So the passive investing, I'll put all my money in ETF and everything will be okay, is perhaps not the strategy to play over the next 5 to 10 years. It worked very well for the past 10 years. It might not work the same way again. Right? So instead of always looking for 5 or 10% growth, perhaps start to think about how can I preserve my capital for my next generation, whilst at the same time saving money on rental if I aspire to educate them in the UK. And I think these are the conversations that we're having now with our clients. We're not under any illusion that, real estate at the moment is relatively illiquid, but things change very, very quickly in a world where there's this much capital and nobody really knows where to put it. People will always gravitate back to safe havens. You could say UK is a safe haven. I personally would prefer to focus on London, but that is me personally, because that's what I know, right? But the UK, relatively speaking, on a global scale, is arguably one of the safest places in the world because of rule of law, taxation, less risk of war, but also sustainable historical growth. So rents over the next 5 years, UK 12%, London 11.5%, slightly outstripping inflation. So it's not going to change your world, but it is going to make you profit. With that said, and I will be here to answer any questions afterwards. I'd love to talk to all of you individually, so please do let me know. But I would like to introduce Yan Yan, who's one of our directors, to talk to you about opportunities for capital preservation and hopefully capital gain. Thanks, Yan.
Hi, everyone. So I'm Yan. I'm going to introduce you to projects in West London. So as you know, West London has been traditionally the most sought after area in London. So the first project I'm going to introduce you is called 50 Brook Green. It's in Brook Green. So where is Brook Green? Many of you may have not heard of this area or doesn't know about this area much. So Brook Green is in West London. It's here. So it's in the edge of Zone 1 at the end of Kensington High Street. So it's very central. It's very close to Holland Park, Notting Hill, Hyde Park, Kensington, and also West City. There are also 3 stations nearby, the closest one being Kensington Olympia. So once you are in Kensington Olympia, you're only 5 minutes by tube to South Kensington, where you have the famous Imperial College. So lots of Hong Kong students go there. And also you have lots of world-class museums here as well. And also within 10 minutes, you are already in Knightsbridge, you are in Sloane Square. So you have Harrods, you have Harvey Nichols, this kind of high-end retail shopping malls here. And also it's very, very close to Kensington High Street, just a few minutes, a few minutes away. And also it's only 4 minutes by car to White City, which you have the Westfield. So Westfield is the largest shopping mall in London. So living here, the transport is great, and also the retail offering is amazing. And also one thing that I need to highlight is the education here. So Brook Green belongs to the borough of Fulham and Hammersmith. So Fulham and Hammersmith, together with Kensington and Chelsea next door, has the best school networks, one of the best school networks in London. So St. Paul Girls' School, this is a top UK girls' school. It just sits opposite our project. It's just like less than 100 meters away, less than 50 meters away. So it's a very, very good school. So this project is perfect for the parents who wants to be close to their kids studying here. And also, apart from St. Paul Girls' School, you also have lots of independent schools and also state schools which are ranked as good or outstanding in the area as well. So the education here is great. So let's look into the details of this project. So 50 Brook Green, this is a project by London Square. So Brook Green, this area is very like Kensington. They're traditionally, it has been a genuine lack of supply in the whole area. So for the past 5 years, there have only been 20 newly added units in the whole area. So if you want to buy in this area, it's very difficult to find a new unit to buy. So developer London Square has spent a lot of efforts in getting the planning permission and also buy the whole development. So as you can see, this is a conversion from an old Victorian-style building. So the whole area, the whole development is gated, which is really, really rare. So if you live here, it's going to be very safe because it's gated, which is really rare. This development offers 37 units only, from 1 bed to 3 beds, from lateral apartments to duplexes. So every unit is very, very unique. So this is the internal specs. As you can see, it's a conversion. So the ceiling height is higher than average. And you have large windows, like the kitchen is fully fitted, wood floors throughout the whole flat. And also the bedroom is also wood floor, which is not carpet, which is more like wood floor is more expensive. And then in terms of private amenities, you have wellness Swiss center where you have yoga, you have gym, and also you have a 24-hour concierge, which can satisfy the residents' needs. So we can we can take one unit, for example. So this is a very good 2 beds. It's on the ground floor. It's here. So you can see you don't have to go into the building. You have your own private door from here. So this unit has 776 square feet, and also 2 large outdoor spaces. One is terrace, the other one is the private garden in the front. You can access from here. So it's a 2x2 bus, and the price is 1.7 million. The completion time is Q1, Q2 to 2027. The payment term is 10% now, and 10% late in 1 year later, and 80% upon completion. So if you want to know details about this project, please feel free to grab our sales consultant later. The second project is called Wimbledon Bridge House. So it's in Wimbledon. As you know, Wimbledon is in Zone 3. So surrounding Wimbledon is Wandsworth, Kingston, Richmond, all these very nice areas in London. So Wimbledon itself is very famous for tennis. It's very famous for the tennis championship. So every year it receives over hundreds of thousands of visitors going there to watch the game. Meanwhile, Wimbledon is also a very affluent area. Like all the locals want to live in Wimbledon because the lifestyle here is great. The living environment here is great. You have lots of parks. You have lots of good schools here. But across the years, Wimbledon doesn't have many new builds coming up. So in the area, it's traditionally houses like big villas, big houses, which are really, really expensive. And today, I'm going to show you a very rare new build, which just launched this month. So this project is called Wimbledon Bridge House. It's in the center of Wimbledon. It's here. So as you can see, across the project is the station. So this station has 4 lines. You have the district line, which is 2. You also have the train. You also have Thameslink. You have the National Rail, which means you can get into London in only 20 minutes. So if you live here, you work in the city, it's very easy for you to get into the city. And also, if you have kids who are studying in London Center, you can also travel very easily from here as well. And also around the corner, you have UK's #1 premier high street, where you can access 650 retail shops within 30 minutes walk. So life here is very convenient. So in terms of public spaces, you also have 14 public parks within the walking distance. You also have lots of shops, lots of cafes in the neighborhood as well. In terms of education, so Wimbledon is very good in terms of education. So you have the famous King's College Wimbledon and also Wimbledon High School. And also you have lots of state schools which are ranked as outstanding in the area as well. So you have very good catchment area if you live here. So this is the internal look of the flat. This development offers only 123 units in total. So you have 1 bed to 3 beds. And also you have 2 color palettes as well. One is light, one is dark. And I'm going to show you a small 1 bed if you want to buy for investment or if you want to buy a small unit for your kid. This one is 560 square feet. The price is 592,000. The completion time is in 2 years later. The payment terms is also 10% now and 10% in 1 year and also 80% upon completion. So the rent is really high here. The rent is around 2,500 per month, which means you're going to get a gross rental yield of around 5%, which is really decent already in this area. That's it. So if you want to know details of these 2 projects, please feel free to speak with our sales consultant.